89.3 and 88.5 Yes FM. Online at www.yeshome.com. Now on the free Yes FM iTunes app and the Yes FM Android app, or the free TuneIn Radio app. Search Yes FM Lima.
Speaking of comebacks, it's time for us to talk about the economy, which may or may not be coming back. We'll find out. Darren Munn is joining us from Munn Wealth Management, as he does every month to help us navigate those rocky shoals of finance. Now, when I talk Munn Wealth Management, does that mean people give you money to you, and then you manage that?
That's true. That's exactly what we do, Tommy. Absolutely.
So you're managing the Munn's wealth.
We're hopefully serving a lot of people. We are serving a lot of people all around Northwest Ohio. In fact, all over the country. So,
well, there you go.
That's really cool.
And in these times we do need a little help because it's getting more and more complicated out there with the economy. And
it's not getting any easier. No. I know that.
So the couple things going on. One, we have the 5-year anniversary of the stimulus, the president's first stimulus, which was $787 billion. That was going to set the economy roaring, and it clearly has been a great success because we're all, seeing wages go up. Joblessness is basically non-existent. The economy's growing at a 8-9% clip, something like that.
Tommy, this is not China.
Oh, sorry.
We're a little bit short of that. Maybe a third of that. Maybe a fourth of that. It's interesting. Even back then, I remember back then, because we really hadn't seen the economic numbers come out. I mean, we were starting to see them, but the recession really ended 6 months prior to that, in June of 2009. So, our argument at the time was we really don't need it. The economy has already turned the corner. It's already growing. So, just throwing money at something like this is not a healthy thing. And, it's kind of like throwing gasoline on fire. It has a short-term effect, but the long-term effect is not sustainable, and if anything, it actually dims the longer-term prospects because you've pulled some of that future demand into the short term.
Yeah, well, and then you got to pay that money back.
Absolutely.
And if interest rates go up, that just chews up more and more of our budget.
Yes.
To pay back, service our debt.
Yeah.
And but someday they'll learn that lesson in Washington. They haven't learned it yet.
It's not their money, and so I guess they just don't feel the pain.
Yeah.
And that's the difficult thing is they're spending money that's not really theirs, and although they talk like it's theirs, but it's leaving us in a big hole.
See, that's why I think we should pass a law that says Congress has to personally make up any shortfall every year. You just assess it out among all the Congress people. In the Senate, you got 100 senators, 400 some odd congressmen. Take that number, 587, whatever it is, divide up what it is, and say, okay, this is your part that you owe. I bet we get balanced budgets tomorrow.
I bet we would. Either that or we wouldn't have any congrrismen.
Yeah.
So one of the two.
We would find ways to cut
I see two possible
spending.
outcomes there, Tommy.
We would find ways to cut spending left and right if we made them personally responsible for it. So we got the 5-year stimulus, which didn't really accomplish a whole lot. And now the latest news that I've been reading, I don't know if you agree with this or not, but a lot of talk about it's not necessarily going to be a good year for stocks. And a lot of people are predicting we're going to see another step back in the stock market, another correction, as they call them in the stock market. Do you foresee that coming? Is it going to be a big one? If it does, will it be a small one? What are the risks out there for people who, have their money in mutual funds, have their money out in the stock market? Is that something we need to pull back from, be careful with? What's the outlook there?
Yeah, I have absolutely no idea. Making predictions about what the market's going to do this year or next year, it's really anybody's guess. We've been seeing those predictions really for the last 5 years, and yet the market has done extremely well. That being said, the market did run quite far last year. We were up over 30% last year. Corporate earnings were up maybe 10 to 15%. So, those normally need to move in balance. So, from my perspective, it looks to me like stocks probably got a little bit ahead of themselves. I don't think we're positioned for a major, pullback like we saw in 08 and 09. But we've not really experienced any volatility for the last, call it 2.5 years, or certainly a good year and a half. And that's not normal. So sooner or later, we're going to see some volatility. That's not a bad thing. In fact, it's a good thing. It's healthy for the market to experience some volatility. What's not healthy is when we just see this unrelenting, move higher. that's not a normal, to me that indicates that there's some outside forces having some influence, so whether it's the QE3, whatever the Fed bond buying is doing, to me it's not a normal market environment. So yes, I believe we're going to experience more volatility than we have. That was my predictions, as you call it, last year, and it didn't happen. So I'm just going to repeat it until it finally does happen.
Eventually, we will see volatility.
I'm going to be
market.
right. Yes,
might be 10 years down the road, but by golly, it's going to happen.
So I expect more volatility. I don't think it's. I would say it's not anything to be particularly afraid of. Everybody should have a plan. They should stick to that plan. Don't let the fears or the predictions about the market dictate what you're going to do with your investments. It's important to have a sound investing plan, to have a sound allocation. If you're doing it properly, any pullback we have is not going to have any lasting impact. In fact, it's normally going to work to your advantage because it gives you a chance to rebalance or buy when things are at better prices.
We're talking with Darren Munn from Munn Wealth Management. As always, if you have any questions, as Darren talking about having a plan, if you have questions about having a plan or questions about general financial needs or information, you can give us a call, 419-240-1937 or 1-800-457-1937. Or you could email or text message those questions to us if you have questions about budgeting, investments, things like that. Just a reminder, he can't answer specific investment advice. So if you ask, he can't tell you whether you should sell ABC stock or not. But if you have general questions, we can address those. And let me ask one of those general questions, because you talk about the buyback. Let's say that we do see a correction in the market this year. Like you said, long term, sometimes that helps because it allows you to buy more shares. If you're in a mutual fund, you can buy more of those shares, buy more shares of the stock, and so later when it rises, that benefits you. What if, however, you're someone who's saying, well, but you know what, I'm planning on retiring this year. I don't want to see, because I know my parents kind of got caught up that they retired right around the time the stock market tanked, and it really hurt them, because they lost a lot of value at a time where they're not, they don't necessarily have the time to make it up later. Do you need to reposition, if you're getting close to retirement, close to that time where you're going to start drawing on those funds, do you need to change your strategy, maybe move into bonds, maybe move that into a more protected kind of area that might experience less volatility?
Absolutely. The ultimately an investment portfolio needs to be allocated based on someone's objective. So if they're nearing retirement or in retirement and income is going to be or is a major, probably the primary objective, the portfolio really needs to be positioned for that. We believe very strongly that the portfolio should be generating that income month in and month out, so that someone's not forced to sell at an inopportune time. That's what hurts people, is if you're in a portfolio and you're making monthly distributions, or you're taking money every month from your account for your income, if the prices go down and you're selling things at a bad price, that's what ultimately hurts. But if the portfolio is generating the income where every month that income is coming into your money market account, volatility is not as relevant. You can weather the volatility a lot easier, and typically those types of investments are going to have less volatility. Not always, but typically they're going to have less volatility. And when we look at where the market ran up last year, it wasn't really, it was really the income stuff that did not necessarily do well, largely because we had the jump in interest rates. So I would say, if a portfolio is allocated in that area, the risks are not as elevated in that area, certainly as much as I see in some of the, let's say, the growth areas of the market.
Let's talk at the other end of the spectrum. If you're just entering into, maybe just starting your first job, entering into a new career, you got a new job, got a 401k for the first time. What are you looking at as far as long-term strategy if you're just beginning? What kind of should be your objective early on?
Yeah, early on, it's get the money saved. That's the most important thing. Get it invested. It's kind of hard to explain. It'd be great if I could show people a picture. But even with where the market is right now, even though the short-term risks may be elevated, if we look at where the market is, the potential returns, let's say over the next 5 to 10 years, are still probably in the, call it 6 to 8% range. So that might mean maybe we have a 15% pullback. But still, if we look out 5 to 10 years, I think the upside potential is still pretty reasonable. So we should never let our fears of what's going to happen in the short term dictate what's going to, what we're going to do for the long term. So for people, even if they're just starting out, don't let that stop you. I mean, in fact, that's when it's even better that the market have some volatility, because then more of your money will get in at lower prices. So, really for all investors, don't let the short-term movements in the market dictate your long-term plan. It needs to, let's have a sound long-term plan, follow the plan regardless of what the market does. Yeah. But I mean, part of that plan is, what do we do if the market pulls back? I mean, that's something that, we always want to know, okay, if the market does this, what are we going to do?
And I imagine, obviously your long-term, you've got time to weather those ups and downs. Kind of the old Warren Buffett school. He's a long-term investor. He just buys quality stocks and doesn't panic if they go down. Yeah,
absolutely. I mean, investing by definition is long-term, and I think with media and really over the last 10 or 15 years, we've turned it into something that's not healthy. Yeah. Investing was never designed to be a short-term trading scenario. It's not, I'm buying today and selling tomorrow. It's, hey, I'm taking ownership of this company, or I'm buying this bond and I'm going to hold it for a period of time. The time to sell something is not is not just because I think I made a little money, or I think I want to buy something else. It's the market is offering me a price that's way better than what this is really worth. That's really when we want to sell. And the time to buy is not when something has been going up really well. It's typically it's when something has been going down, because that means the price is better for the cash flow that's being generated on that investment. And so it's I mean, we all know, hey, when stores have a sale, when prices come down on everything else we want to buy, that's when we go buy. But we have this inverse logic when it comes to investing, that when prices go down, we sell. And when prices go up, then we buy. I mean, it's totally different than everything else we buy or sell. Yet, it's because over the last 10 or 15 years, we've become so ingrained to this short-term trading mentality, and it's not healthy. And it hurts people. I mean, study after study after study has shown the average investor dramatically underperforms the market overall. I mean, and we're talking like missing 75% of the market returns or more because of those short-term movements. And that's why for most people, hey, you need to have a solid plan. My bias is you need to work with an advisor that really knows what they're doing, and then you need to stick with that plan and trust. A lot of times it's trusting your original judgment. Just because something goes against you in the short term doesn't mean that you made a bad decision. Yeah, it just means that for whatever reason the supply and demand balance in the market has shifted. It doesn't mean that it's a bad company or a bad stock or a bad bond. It just means that for that day and time, the supply-demand balance has shifted. The market is a perpetual auction. It's constant buying and selling of the same stuff. So imagine if you go to an auction and all of a sudden there's no buyers that day. Yeah. What's going to happen?
Prices go down.
Prices are going to be dirt cheap, which is great. That's the kind of auction you want to go to, right? But if you go to an auction and there's 100 people there all bidding on a few items, the prices are going to be a lot higher, and you're not going to get any deals at that time.
So you're saying I shouldn't take a second mortgage out on the house to go play the futures market?
I would not do that, Tommy.
What about lottery tickets? What if I bought a bunch of lottery tickets?
Well, that's different. That's different.
That's sound investing there.
Yeah, you're almost guaranteed to lose there. But at least you know what's going to happen,
Yes,
so,
you're prepared for your losses.
You might as well just turn the deed over to the bank and absolutely
move into the trailer park.
Yeah, I would make sure you let them know your plan before you do that, though. Just tell them, just in the interest of full disclosure.
That might inhibit my ability to get that.
Well,
how I'm thinking.
Well, I don't know if that's what happens,
maybe. I don't know. They may not think. Those bankers, they're all stuffy. They don't. They can't see the kind of innovative financial stuff I'm up to.
Tommy, your ideas are just out of this world. I'm
ahead of the game.
Absolutely.
20 years from now, everybody will be investing like this. The sad part is that may be true.
Well, the sad thing is there are studies done about that, and a significant, and I don't remember what the numbers, but I mean, we're talking, I think it's better than 20% of people in this country believe that winning the lottery is their best chance to achieve a secure retirement. Yeah. It's really sad. I mean, when you look at the numbers, and especially it's the people that can least afford to lose that money. And so it's really a tragic scenario, and it is heartbreaking. Because the reality is if people would simply put the money that they're blowing on things like lottery and other things like that, it would actually give them a pretty decent retirement if they would just get that invested.
Invest it instead of
let it work for them.
Hoping the casino will come through for you.
Absolutely.
Yeah. We're talking with Darren Munn, Munn Wealth Management, as he's in with us every month. Darren, thanks so much. We always appreciate your time.
It's great to be here, Tommy. Thank you.
Yes, FM.